There's already so much going on with geopolitics and markets at the beginning of the year. Luckily, I have with me Michael Field, who's going to explain what's really going on. Last time we spoke, Michael, markets were already pivoting towards the idea of rate cuts, and there was a feeling of exuberance. That just seems to have vanished within a matter of weeks. So what's really going on?
So I think the market rally that we saw in December, as strong as it was, and it contributed heavily to the returns that investors got last year, was pretty fickle in origin. It was very much sentiment driven. So people were kind of saw this kind of upside of interest rate cuts, and they got slightly ahead of themselves towards the end of the year. And a lot of people thought this might carry over then into 2024, but suddenly that kind of enthusiasm has faded. And that's what happens when you have rallies based on kind of non-fundamental things. They're quite fickle and they fade off again. And that's the current kind of situation we find ourselves in now.
Sure. It seems a bit early to sort of write off the markets. I had a commentary this week saying hopes of a better year for the FTSE 100 are diminishing already. I'm thinking it's a bit early in the year to start trying to, that we're in the market of making predictions, but it's a bit early. It's only kind of 2 weeks in the trading. So I read a piece that you'd written, and you were saying that investors are just going to have to be patient in terms of sustained returns. And if there isn't a huge rally in January, it doesn't matter a huge amount.
I think that's fair. Yeah, that the message hasn't really changed from that perspective. Ultimately, you're investing, and you should be investing based on fundamentals. Now, for the market itself, we think the market is kind of roughly fairly valued. But within that, there's various sectors and subsectors that are really undervalued, that have a lot of opportunities at the moment. So, if you want to be long-term in that perspective, you really have to dig in deep, find those sectors that are undervalued, and then invest, and not expect a swift return on your capital, but expect that over time that story will play out, and ultimately you'll get the reward for your work.
Sure. In terms of geopolitical risk, one of the things I hadn't seen coming at the end of last year was the issues in the Red Sea and the shipping disruption. And even today, sort of rockets fired between Pakistan and Iran. It seems to be that investors have a new thing to worry about every month. This is just normal now, isn't it, for the markets? Or
we've had periods in history where there's been a lot happening. And I think we were just lucky in that we probably had a 10, 12-year period there after the financial crisis when the geopolitical crises that we faced were kind of fewer in number. And now suddenly we've been hit with a lot since the pandemic, the Ukraine war, the Red Sea issues now that we're facing. The difference really is how many of them have a real material impact immediately on markets is the other question, right? When the whole Israel war kicked off a couple of months ago now, we did some analysis on how many stocks were affected. And in the scheme of things, if that conflict stays isolated to that region, there's little impact on kind of Western markets. But as you said, the more things happen, the Red Sea crisis, if other things like Iran and Iraq and things like this start flaring up again, obviously that has a much bigger global effect. We've spoken about defense stocks as well and the kind of structural growth story there. So certainly there's knock-on impacts, but it's important to kind of look at these things one at a time and really assess how much material impact each of them have, I think.
Sure. They may have a cumulative effect at some point where the markets say, look, we're taking geopolitical risk seriously. But with every crisis, there seems to be an immediate reaction and then kind of return to normality. Another story that's sort of perked up since we last spoke is inflation. And I wasn't hugely surprised to see UK inflation back up this week. I read headlines today about inflation shock. The US has seen it, the Eurozone's seen it, and now the UK's seen it. How do kind of market participants change their view of this year based on where they think rates are going and, inflation's sort of sticking around?
So I think the first thing is to kind of put it in context, right? The UK had 11 months of declining inflation, and inflation fell from 10% to 4% basically, which in the scheme of things is a great result. I think we all would have taken that at the beginning of the year. I think the shock, if you will, as you put it, to markets is that it didn't decline in December. It actually went up 10 basis points, which, yes, it's disappointing if you'd expected that straight line decline, but in the scheme of things, does it change the picture? Not massively. Ultimately, our view of inflation is like this. inflation has come down an awful lot, which is great for markets and should help, certain sectors of the economy, at least this year. And it should help consumers, right? Their belts have been tightening for a while, and this should take some of the pressure off. But at the same time, inflation's still twice the level of the Bank of England or the ECB's targeted rate. So from that perspective, there's a lot more to go. So it's not mission accomplished yet. It doesn't mean immediate rate cuts either. So there's a bit to factor in, but certainly we've had a lot of progress in inflation. That shouldn't be kind of dismissed.
Sure, yeah. I mean, if you look at the trend line, it's a big lurch downwards and a little tick up rather than, a big reversal. Just sticking with the theme of the consumer, I mean, earnings season's already kicked off in the US and it's kind of about to in Europe. I mean, you kind of think that consumer-facing companies are going to have a tough time of it. I've already noticed 3 profit warnings so far. In the UK, at least, Burberry, which is sort of luxury exposure, Crest Nicholson, housing market, and Page Group, which is recruitment. So they're all different sectors, but they all have a kind of overarching kind of consumer link. So you fear for consumer-facing companies in this coming earnings season?
To some degree, it's the sector that we're saying that you should expect differing results, right? Some of the companies are still managing to fend off inflation and pass through price increases, and some of them are struggling at this stage. They've been passing through maybe double-digit price increases for 2 years now to consumers, and a lot of consumers are simply that stretched that they can't afford anymore. I think the 3 companies that you said, yeah, you're right. They all differ in terms of the industries that they are involved in, but they have one common link, right? That they're all at the coalface, be it a luxury goods firm that's dealing with end consumers, be it a recruitment company, which we all know are highly cyclical, or a house builder also. They're very much at the coalface. They're very much seeing the impacts of high interest rates and high inflation to some degree up to now as well. So I think what consumers, or what the investors rather, are kind of maybe missing is that, yes, the picture looks brighter in terms of interest rates coming down from here, but the fact that interest rates have been kind of really high for a little while now means that still has to feed through, and that can mean kind of more pain for the next, call it 6 months, before we see any kind of upside again.
Sure, that's an interesting one. I mean, this is my favourite earnings season because it covers a whole year period for a lot of companies. So you get a bit better picture than, say, Q3 earnings. But as you say, I mean, what investors really want to know is forward-looking stuff. They don't necessarily want to know what you did last year. They want to say, you want them to say, look, things are getting better. But you're kind of suggesting that investors need to just wait a bit for inflation falls to pass through, consumers to feel a bit better. And it's not an immediate gradual process. It's a gradual process rather than an immediate one.
I think that's a pretty good conclusion, yeah. And if you look, as you said, it's forward-looking. And for a lot of these companies, the visibility is relatively low. They can only tell you what they're seeing perhaps over the last few weeks. Recruitment companies generally, I know, having covered these, their forward visibility is a maximum of about 6 weeks. So yes, it's interesting. Yes, it's good to kind of take it into account. But if you're a long-term investor, you really need to have your own view and kind of supplement that with what the companies are seeing right now, rather than just take exactly what they say and extrapolate that into the future.
Sure, yeah. I mean, Burberry's an interesting case of that because it was quite a significant profit downgrade. I don't necessarily want to talk about Burberry in detail, but do you expect earnings seasons to be full of those sort of nasty surprises for investors? And the last earnings season, we had some big share price falls. So are investors better prepared for nasty surprises? Or is it going to be like 10%, 20% share price falls on the day sort of thing?
I think you could see a little bit of that. I think, yes, investors should be prepped for more surprises, but at the same time, it's difficult to know exactly what to expect. And there's so many moving parts, right? So you've got some companies benefiting from falling inflation. Some of them will be able to hang on to those kind of price increases while benefiting from lower cost bases, which then you could see profits rise for some industries. And some are really going to struggle to pass on those increases. And then others are, paying really high debt payments, and perhaps they've had to refinance towards late last year or something like this too. So it's going to be very mixed, and I think investors won't know exactly what to expect from each company. So certainly on the day, you should expect some surprises, and I won't be surprised if we see some reasonably large share price moves as investors kind of struggle to adapt immediately to the new conditions for these companies.
Sure, yeah. I mean, it makes for good copy for journalists necessarily, but is an unpleasant experience for investors. You mentioned debt there. That's quite an interesting element to it, because I remember going into COVID, the heavily indebted companies were seen as pariahs, and they spent ages trying to clear up their balance sheets, rights issues, all that sort of thing. Do you think companies are now more in better shape, more resilient financially? I mean, they're borrowing costs haven't really budged. I mean, they're still really high, right?
I think there's a big difference here as well and this is why valuation has moved for maybe large cap stocks, and there's a bit of a gap between them and mid cap and small cap stocks, because a lot of the large cap stocks have very strong access to capital markets, both an equity perspective, but also debt markets. That I've seen some companies that I've covered issue debt in the last year at kind of government levels, or even slightly below government bond yields. So that they haven't really budged, and a lot of them have staggered their debt over a number of years. So their actual financing costs aren't huge, but a lot of the smaller and mid-sized companies haven't had that luxury and have had to refinance as and when they needed it, in maybe a less organized fashion. And then suddenly they might be dealing with higher debt costs for a year or two before, that kind of smooths out again. So it could make a great deal of difference for some of those smaller mid-cap companies rather than the large cap companies, perhaps.
Sure, that's interesting. Completely different profile of debt, but I guess they'd be looking for interest rate cuts more than most, but they might have to wait a bit longer for that. If you don't mind, we go on to sectors as our sort of last bit of our conversation, really. Just looking at your most recent note on what you think of undervalued, say utilities, healthcare, consumer defensive and communication services. That's quite a wide range of companies. But which sectors are you particularly keen on for this year?
Yeah, well, I think first of all, it's good to have so many opportunities that are undervalued still, sure, even though markets are fairly valued, which is an interesting one. I think even just picking a couple of them, right? So consumer defensives, I'm as surprised as anyone that it's trading at a pretty good discount to where it's supposed to be. A lot of these companies have structural kind of growth stories. They're very defensive over the longer term. Okay, some of them are struggling now a little bit after 2 years of really high inflation, but longer term, they tell a very good story. And then within that, you've got names like Anheuser-Busch, one of the, if not the largest alcohol beer manufacturer in the world, that's trading at a pretty sizable discount currently. Investors just aren't 100% sure that there's a volume growth, that consumers are cash strapped, etc. Then things like Nestle as well, right? The kind of flip side of that, but in terms of other kind of consumer goods, again, trading at a discount to where we think it is, and a pretty rare discount at that as well. So there's some opportunities in real kind of household names that you might not have thought there would be. And then perhaps the other one is then in healthcare, that it's really bifurcated. So there's a big investor focus on the obesity drugs. You had all that kind of fanfare last year about obesity drugs and the impact that would have on the industry, and maybe on other industries like snacks and things like this as well. But there's kind of other industries within that as well, within healthcare, that have kind of been overlooked. So we think like second generation beneficiaries of these obesity drugs, like Roche and Pfizer, are kind of materially undervalued. And then some of the names that were heavily involved in the COVID vaccine, like Moderna, for instance, again, these names have kind of been overlooked by investors who have kind of somewhat lazily bracketed them as, a specific segment related to only COVID, and are kind of ignoring the bigger pipelines that many of these companies have.
Sure, brilliant. Well, thanks for that summary. Let's catch up next month, and we can pore over earnings season, see the winners and the losers. So thanks so much for your time, Michael. For Morningstar, I'm James Gard.